Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And in today's video, we're going to cover a brand new style of covered call ETF that recently came out in Canada. You have 6 of them now. So Harvest launched one, Hamilton launched one. Hamilton was the first one to launch it. Now Evolve has launched one, and even Horizons, they launched 3 of them. So of course I'm talking about these covered call ETFs that do covered calls on US government bonds, right? So the first concept of this style of ETF really came out by BlackRock about a year ago. So BlackRock came out with TLTW. So in case you didn't know, TLTW is a covered call ETF that just does covered calls on TLT. They're both BlackRock ETFs, and TLT is basically an ETF or a US listed ETF that invests in long-term US government bonds, aka T-bills, aka treasuries, right? So it's a very, very safe investment for the long term typically. And because of the higher volatility now with interest rates, a lot of people are starting to look at fixed income and saying, well, it's actually worth it because you could get really nice high yield when you couldn't, when rates were really, really low, right? So if you're getting a 4 or 5, it's about 5% or something like that, maybe even a bit higher. If you can get 5-6% or something like that, and you add covered calls, you could easily make 10, 12, and even up to, like we'll see, 15% yield. So this is a very interesting concept because it's the first really covered call ETF on fixed income, right? On something super, super boring, and could get really, really nice high yields. But the problem is now there's so many of them. There's actually 6 in Canada now. What are the difference between them? Which one is the best for you? Remember, we're always trying to figure out what's the best for you. I think the best doesn't exist. It's all about trying to figure out which solution is best for your situation. So in this video, let's go through all 6 of them. We'll try to figure out the differences between the 6 because there are subtle differences. And I've also been watching them. So we'll check out the last week or so of price movement to see how they're behaving every day when they go up or when they go down. So we'll figure that out together, and hopefully by the end of the video you understand the differences between the 6 and which one is possibly the best fit for your portfolio. Let's get to it. All right, everyone, let's go through the 6 ETFs together real quick. We'll try to figure out the differences between them. Then we'll look at the stock price movements of all 6 of them for a couple of days. And then at the end of the video, I will tell you which one I personally invested in. And of course, PII Inner Circle members already know exactly which one I invested in. Again, if you're interested to become an Inner Circle member, hit that little join button at the bottom there. You'll get all the list of perks and the description of what that program is about. But one of the perks is live stock trade alerts. So you know exactly what I'm doing, what I buy, what I sell the day of, instead of waiting for the next portfolio unveil. So if you're interested, it's very, very cheap. Click the join button. So let's go through all 6 of them here. This one came out first from Hamilton. Got to give them props to come out with the first one, H-Bond. Just a reminder that although these are holding all US stuff, these are all Canadian listed ETFs, which means you don't have to worry about the 15% withholding tax if you have it in the TFSA or non-registered. It's all handled within the funds, okay? All right, so unlike TLTW, if you would hold TLTW, you would have to pay the 15% withholding tax because it's listed on the US stock market. So the first one is H-Bond. You see here that the target yield is 10% plus. A lot of them are going to be about 10% plus here. And most of them all have the same management fee, by the way, of 45 basis points. So except for the Evolve one, which has a discount, but we will go through that in a second. So I'll have to be honest, the H-Bond one, HPYT from Harvest, the bond one from Evolve, and even LPAY from Horizons are all extremely similar, whereas they're mostly, or some of them, it's exclusively in the long-term bond. So really the difference is going to be the duration, right? The longer the duration is, the H-Bond, for example, is, you see here, if you look at the pie chart, let's make it bigger here, 80% in long-term. So TLT, by the way, is going to be, like I said, it's the most popular, biggest liquid ETF, best thing to write cover calls on. This is the 20-year plus. So 20-year plus, everyone, is considered long-term. So you have 50% in that, 30% in the Vanguard long-term treasury, it's probably 20 years as well. Then you have 10% in intermediate, this would be medium term, and then you have 5 and 5 in the short-term one. So it's 80% in long, 10% in medium, 10% in short. So the majority in long, term, which means, you know, the longer it is, the more you see here the average maturity 20 and the duration 13.7. So I guess the average is 13.7 here for this one if you combine the average. So my point is the longer the duration is, the more sensitive the ETF could move in terms of interest rates. So when interest rates start getting cut, start getting reduced, the long-term ones, TLT, VG, LT, should start going up in value more than the medium and the short-term one, right? So you definitely, but if the interest rates go up, they will go down in value. That's why you see TLT has gone down a lot lately the last year, because interest rates have gone up. So obviously you're getting compensated by that extra volatility with more reward, right? So this one here is 10% plus yield, the covered call strategy, and that's what we really need to focus on. What is the exact covered call strategy of each one? This is going to be on 50%, roughly 50% of the portfolio using at the money options, right? So you're pretty much giving up half the upside in case interest rates start getting cut and TLT go up. TLT goes up. So you're losing half that upside, but of course you're getting that yield. So this is the first one. This is H bond. So that is the strategy here. 80% long, 10% medium, 10% short. So very unique. Next one is HPYT. So this is going to be the highest yielding one by far. It's 15 yield plus. Why is it so much higher yield than the other one? Well, the main reason is, first of all, if you look at the portfolio, it's going to be 65% in TLT. You have the breakdown here. It's pretty much all long. So this Harvest has decided to go fully with the long-term bonds here. And they're not only that, but you know, if you look at the product sheet or fact sheet, they're writing more covered calls. So you could see here they're employing up to 100% covered calls. So this is the first time Harvest has done this. Usually they do up to a third, but here, and if you look at the fact sheet, they say that the base level is 75%. So they're going to do at least, at a bare bone minimum, 75% coverage of covered calls, but they could go up to 100. So 75% to 100, you're going to expect about at least 50% more yield, which is exactly why it's 15, right? They do 50% more, approximately 50% or even more covered calls than what H bond is doing. So it's only normal you're going to get 50% more yield, guys. So very simple to understand. So this one here, all long term, and it's the most aggressive with the covered calls. They do a lot of covered calls on this one. So it's going to be the highest yielding option here. And the yield is just under 16% now, because it's gone down a little bit here. For all of them are actually a bit higher. The yields are a bit higher because the ETFs have gone down a little bit. So the third one is Evolve. This is bond and pretty mostly long, I believe. If we look at the portfolio, it's all in long. So it's 60% in TLT. This is TLT. And then they have the 40% in the long-term Vanguard one. You see that here. And then you actually see all the calls. They're writing the calls on TLT. I think most of the providers, guys, are going to be writing the calls on TLT, because TLT is the most liquid when it comes to options, right? So just like the Harvest one, all 100% long, except they are writing up to 50%. So the cover call strategy in terms of ratio is similar to H bond. So Evolve is very, very similar to the H bond one, to be honest, except it's 100% long. And so the yield is going to be about the same, near 10%. But the thing to mention for bond, for this one, is that they are waiving the management fee until March. So there is no management fee. Let me see, you probably see that here. Yeah, you see that here, 0%. So they've waived the management fee. Let's look at the double star. I'm pretty sure it's till March here. Yeah, until March 31st. So that's pretty significant. I'm assuming that well, let me see here, trailing being 75 basis points. So they're all 45 basis points. I think this one might go back to 75. I'm not sure. I'll have to look into it further here, but this is definitely very interesting because there's no management fee until then. So that's why bond is very, very attractive here. Let me just pause and let me come back. All right, sorry about that, guys. I just wanted to confirm the management fee. I did find it in the fact sheet here. So I thought it was going to be 45 basis points like the other ones, but it's not. It's actually 75 basis points, which I find odd. Maybe they'll change that, but regardless, for the bond one, for this one here from Evolve, there is a 0% management fee for the next 6 months. So that's actually very, very attractive. Even the Harvest one, by the way, I apologize, didn't look at it and show you, but it is 45 basis points. So 45 basis points, just like H bond is 45 basis points. This one's actually, I guess, 75, a little bit higher, but they're waiving it for 6 months. I have a feeling they'll probably lower it back to 45 basis points, but I could be wrong. Next one is from Horizons, a long-term one from Horizons, LPAY, very easy to remember. A little bit higher yield, target is 10.5. Remember, these are new, so these are just approximates here. Management fee, again, 45 basis points. The average duration is 12. So although it says long, and by the way, covered calls up to, it's 40%. So 10% less than H bond and bond, which is 50. And if we look at the holdings, this is where it gets interesting. So again, you have TLT. Makes up the big one. And then you have the Vanguard one again. So 80% here in long, and then you have 20% in the Horizon 0 to 3 month US T-bill ETF, which is this one here, ubill.u. This is actually the really, really short one, 0 to 3 months, guys. So it means you know it's going to yield whatever the current interest rate is, basically, more or less. So I found that very, very interesting because they say long, but it's not 100% long. It's 80% long, I would say. And 20% are really, really short. So the average ends up being 12.76 years in duration. H bond is 13.7. This one's going to be the highest, right? I don't know if they actually put it here. Yeah, look at it here, 16.8. It's much higher, right? So in terms of duration, and then Evolve is all long, it is completely long as well. So it does say long, but it's not really, you know, it's 80% long, 20% short. I found that very interesting. Same management fee, 45, just like the Harvest one and the Hamilton one, but 40% covered call. So this is the long-term one. So where it gets interesting is that they also launched, Horizons that is, a medium-term one and a short-term one. So MPAY is the medium-term one. Yield is a bit lower, of course, 9%. They're doing covered calls on 30%, so that's also 10% less than the LPAY. Management fees a little bit lower, it's 0.40, so it's 5 basis points lower. You see here the average a lot lower, right? 6.67. And if you look at the holdings, it's 60% predominantly in this ETF, but there's a 40% in TLT. So I guess if you take the average, it's medium, right? And then the short term, like you probably could guess, obviously it's going to be a bit lower yield because it's shorter term, and they're doing less covered calls. That's why it's on 20%, right? That's why it's lower yield than the MPAY one. And the management fee again is 0.05 less. So it's 35 basis points instead of 40 basis points for the medium one and 45 for the long. So how, which one should you choose? Which ones is really a right fit for your portfolio? Well, obviously the ones that are going to be less volatile and sensitive to what interest rates do is going to be the MPAY and the SPAY because they're shorter duration. So what I've done is I basically really just put them all together in the stock app and track them and see what they do. And what I've noticed is that all the long-term ones, which is the Harvest one, the Hamilton one, the Evolve one, and even the Horizons one, kind of all move together, right? So this would technically be a bad day. So maybe interest rates didn't go up, but maybe there's speculation that they might go up, and bang, the long-term ones are going to go down a little bit. But you see the MPAY and SPAY, barely phased, right? Barely phased. Let's look at another day here. Same thing, right? All very similar. I personally do expect HPYT, or the ones that are 100% long to go down the most, but also they have the most potential when interest rates get cut. So again, look at the prices here. Very, very similar in terms of percentage. MPAY and SPAY barely do anything. Let's go to the next day. Here's a good day. So during a good day, you see HPYT has benefited a little, the most here, but it's so close that it's almost potato. MPAY, SPAY didn't move at all. Here's another day here where HPYT, the Harvest one, has gone down the most. You have bond almost the same, H bond almost the same, and then you have LPAY a little bit less. So listen, it's not going to be perfect, and of course MPAY and SPAY are not moving at all. Do I have another day? Here's another bad day where the harvest one went down the most, and then you have LPAY bond and H bond kind of all almost the same, just a little bit less here. Again, MPAY and SPAY not phased in the slightest. So that's really the what you could expect in terms of the price movements, everyone. So which one is best for you? Well, in my opinion, if you're like me and you're a yield first investor, obviously the highest yielding one is going to be the harvest one. And I will admit to you now that that is the one that I personally invested in. I invested $20,000 in it in October. You'll see that in the next portfolio unveil video, but of course, Inner Circle members, you already know that, right? So this is the one I invested in. It's really by far the highest yield. It's the one I like the most. That's just me personally because I'm a yield first investor. But then you know, if you're more the middle ground and you want the long term, you don't mind taking the long term, it's really up to you to choose the H bond one, the Evolve one, the Horizons one. They're all three of those are really, really similar, right? The covered call strategy is almost identical. 40% on Horizons, 50% on the Evolve and the Hamilton one. The management fees, well, Horizons and H bond are the same. Evolve is the one that has no management fee now, 0 until March. Then it goes back to 75 basis points. Maybe it'll change that. Maybe they'll lower it to 45. That would be my guess to be competitive, but maybe not. I don't know. So, you know, if you want to hold it, you know, a bond is definitely interesting because of the management fee. But hey, maybe you like Hamilton better as a manager. You like Horizons better as a manager. The three are very, very similar. Where it gets interesting is that if you're looking really shorter term, for example, to park cash for 6 months, a year, you want something less volatile but a really nice yield. I personally think between SPAY and MPAY is really a really good option because you have significantly more yield. You have 1.5% more. And it's really, the duration is really not that long. I mean, if you look at the holdings, it's 60% in the short and only 40% in TLT. So I think, you know, if I had to park cash and I was thinking short term and I was trying to decide between SPAY and MPAY, I personally would go with the MPAY. But hey, if you really want the short, SPAY could be a good option. It's basically really short. It's basically U with covered calls. So the ones that will benefit the most for sure in terms of price appreciation are going to be the long when interest rates start getting cut. But the harvest one, because it has more covered call coverage, and keep in mind it is an active approach. I really like that harvest is saying, look, it depends. It's an active approach. I expect, you know, this one to maybe not appreciate as much as H bond, the Evolve one, and the LPAY. Simply the only reason is they're doing more covered calls. That's the only reason. But because since I'm a yield first investor, I went with HPYT. So hopefully this video was useful for you. You understand the differences between them. Again, the really big differences are going to be the management fees, which most of them are the same, the long ones, the duration, and the cover call strategy. That's really the biggest difference between them. And again, you have really cool MPAY and SPAY options if you're looking for a place to park cash. MPAY is really now a great option, and I would have added this one to my parking cash video that I made a month or two ago. Maybe we'll add it for next time. So if this was useful, please hit that thumbs up. I would really appreciate it, and we'll see you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the Ultimate DIY Investing Package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or companion or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And PASSIV, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of PASSIV is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.